I'm here to introduce something new to you. I'm going to start a new segment where I'm going to go over geopolitics, economics, and even conspiracy theories. Yes, conspiracy theories. Previously, you've only seen me do market updates, but I've always been into politics. In fact, I was a political science major. I've always been into economics. In fact, I look at stock market all the time. I'm looking at charts all the time, making predictions based on that, and pretty good results so far. So I wanted to share that with everyone, and also some conspiracy theories, which conspiracy theories really is a conclusion, a theory you have that hasn't gotten a nod of approval from an official organization, hasn't gotten a nod of approval from the government. And that's okay. As free-thinking people, we should have our own opinions and ideas and conclusions without an official nod of approval, right? We should be okay to think on our own. And that's why I find it very important to share what is on my mind. So I'm going to call this new segment that I'm doing here, The Fruits of the Empire. Let's get started. Now, you've probably heard about the Fed pivot in December. The FOMC, the Feds, they had a meeting in December, and they've decided their fight against inflation is over. They won. Year over year, inflation has gone down. I forgot, it was like 2 to 3%. It's in line with their target. They had a 2% target, and they pretty much met their objective. So they decided they're done fighting inflation. So that is now considered the Fed pivot. They went from raising rates for almost 2 years, and now they've decided to stop. They're no longer going to raise rates. In fact, next year, they're probably going to go ahead and cut rates 2 times at 25 basis points, so 0.25%. Now, that has led to interest rates going down. The mortgage rates were close to almost 8% earlier this year, around October. Now it has gone down to, on average, 6.61%, talking about the 30-year mortgage rate, of course. The 15-year mortgage is at 5.95% now, so close to 6%. I've been hearing a lot of talk about interest rates going down to 5%, maybe even 4.5%, from a whole variety of people, from mortgage brokers, from buyers waiting until next year for rates to go down. My take, not so fast. I don't think it's going to go down that much further. In fact, one very important thing I'm backtracking about the Fed's pivoting. They're not actually going to go ahead and lower the rates dramatically. They're lowering it by 0.25%, 25 basis points, twice next year. Maybe 3, who knows? They always say one thing and they do something else. But even if they go ahead and cut it those 2 times, those 3 times, the impact will be negligible, in my opinion. Example, there's lots of business that are financed at a low rate. They financed it close to 0. So when they come to refinance, it's still dramatically higher, where that debt service is more than they can manage. I'm talking about businesses. There's a lot of businesses that were surviving on debt. So no matter what, this debt service is more than they can handle, and we're still going to see a lot of bankruptcies, a lot of job losses. So we're not out of the clear yet just because of the so-called Fed pivot, although the stock market has gone up dramatically now. Now, back to the mortgage rates. I digressed a bit. We're looking here. You can see here on my mouse right here. It's showing you all the rates right now on average as of today, this month in December. It's close to almost 8% over here. But you can still see it's still very much historically low. I don't think they're going to go down to even 5%. They're most likely going to stick around 6%. But at the same time, home prices are going to stay stable. In fact, there's still going to be very low inventory, still a lot of buyers. I don't think every single buyer out there is going to rush in also. So at the same time, we're still going to see multiple offers, but we're not going to see as many buyers. So we're going to see less transactions, but prices are still going to be stable. Less buyers, less inventory, although still more buyers than there is inventory. So I think that is what's going to save the market, and we're not going to see a crash at all, even though interest rates are still going to stay very elevated. 6% to 7% is my prediction. It's probably going to stay around there. Now, I also want to show you a chart, so you can see what I'm talking about or why I'm thinking that it won't go down significantly. So you're looking over here, we're looking at the 30-year rate index. Don't mind this number at 7.8%. I never know why it's stuck over there. I want you to look at the candles over here. So if you see this, where my mouse is, the little crisscross, there's one tiny little candle here. You can barely see it. This is a weekly chart, by the way, WK right here, weekly chart. And what I did in order to analyze the rate over here is this leg up over here. I drew a Fibonacci sequence right here to analyze the retrace that is happening over here. Essentially, you've seen it gone up and now it's going down for a retrace. What's important is this area right here. Now, this is a weekly chart. Admittedly, they did close past this line right here that I mark in pink, the 61.8% line. And because of the close past it, the likelihood of them coming down to even 6.38% is very likely. And then once they start closing past there, they're likely to come down to 5.98%. This is by percentage, by the way. The charts over here, they just have a dollar symbol, but this is interest rate, which actually, if you see over here, 6.6%, it does match what's going on right here on daily mortgage rates, 6.61%. You can have faith in this chart that we're looking at. So this is really the main determining line, and it did close. But at the same time, this is a weekly chart. What's important is the monthly chart as well. Take a look over here. It was on a phenomenal rise. It's still on an uptrend, interest rates. It's very normal for a retrace. So you see over here, back in November 2022, it gone up to close to 7.1%. By the way, I want you to look at the numbers over here on the right. Every time I move my mouse, you can see the number on the right. It's a little gray box. I can't move my mouse to show you. But you can see over here on this candle, it was at 7.16% interest rate. It came down to 5.98. Let's call it 6%. And then it shot back up. So it's very important to realize it's coming down, but it's definitely not going to go any lower than 6%. I mean, they're going to come down here. Of course, they can start closing and go even lower. But I see strong support over here. It's likely to bounce back up and be closer to this range where we are at right now, closer to 7%, 6.5% to 7% is where I see interest rates staying at indefinitely for the next 5 years to even 10 years, because we have some geopolitical issues out there that is going to make it difficult for this country to lower the rates any further without causing significant inflation. We're already seeing the impact of it. There's a lot of strikes going on, hotel workers demanding more pay, and the McDonald's workers already got their raise. So that's why I see we're most likely going to stick around 6.5% to 7%, and it's going to stay like that for the foreseeable future. So despite a lot of the hope out there, wishful thinking, and realistically, that is what will make everyone the most money, right? If the rates went down, more buyers, then the loan brokers get more pay when they have more loans to finance. And buyers are happier, they have lower rates. Real estate brokers like myself would be happy. But realistically, I think rates are going to stay around 6.5% to 7% for the foreseeable future. So let me show you another angle of the Fibonacci sequence, how useful it is. And I know for the most part, you may have heard about the Fibonacci sequence used for the stock market, but it works just as well for pretty much everything out there as long as it's charted. It's really a measurement tool to kind of target and see where things are coming along, right? So you overlay it on the numbers and it gives you some perspective. And when you see it closes past something or if it's held at a certain point. So let me show you over here in November 2022. Very easy. You could think rates are going down. But right here, it got supported at the 23.6 area of the Fibonacci sequence. And you see it pop right back up. So that was this entire leg over here from the low at 2.77% all the way to that then high of about 7.16%, gone down to about almost 6%, right? The 6% mark. That's why I think it's a very strong area there, 6%, although I think most likely will stay at 6.5%. So let me go back to that area where we are now. I'm drawing at this most recent leg high from that. So at this leg right here, it's very important. Let's see where the month closes. It's very possible it may go up last week and close back above that 61.8%. Very unlikely, but I do see it holding up over here at 6.38% and then likely bouncing back up. And that's why I see it most likely at 6.5 to 7%. That's it for today. I mainly wanted to introduce this new segment that I'm doing, the fruits of the empire. I'm going to have a lot more. Like I said, it'll be about geopolitics, economics, conspiracy theories. Those are always fun, and that will really tickle everyone's mind. We're looking forward for an exciting 2024. I think 2024 is when things will get real. Election year, there's still the war in the Middle East. There's the BRICS where they're trying to replace, no way they're going to replace the dollar, but they're trying to compete with the dollar, which will give it a run for the money. And always having competition, you always have to straighten things out. So that's why I say the Feds probably can't even go down too much with the rates. Otherwise, we're going to have massive inflation problems. We'll save that for next time. Thank you for joining me today. I'm looking forward to sharing a lot more with you.